Nail salons look like the easiest business in America to start. Low overhead, a folding table and some polish. Cash customers walking in off the street every day. A franchise fee that seems almost too cheap next to a fast food chain. People see that $25 manicure on the sign outside and think, anyone could run this. Buy a chair, rent a corner unit, watch the money show up. Here's the twist, and it shows up fast. That $25 was never really a bargain. It's a number that only works because somebody else, usually the person doing your nails, is quietly absorbing the part of the cost that never made it onto your receipt. Getting into this business is, on paper, almost absurdly cheap compared to nearly anything else you could open on a commercial strip. At the very bottom, you don't even need a storefront. Rent a booth inside somebody else's salon for $5,000 to $15,000, bring your own kit, and technically you're in business. A small home studio runs a bit more, $2,000 to $10,000, covering a table, a lamp, a polish collection, whatever licensing your state demands. Step up to an actual commercial location and the range widens fast. A no-frills storefront with 4 to 6 stations opens for $25,000 to $75,000. Push into 8 to 12 stations, proper pedicure plumbing, nicer finishes, and you're at $75,000 to $150,000. Go upscale, full spa, premium build-out, and costs stretch past $200,000 before a single manicure gets done. Then there's franchising, and this is where the range stops looking like a beauty business. Davy Nails, mostly planted inside Walmarts, gets you in for $68,000 to $177,000. Frenchie's runs nearly double that, $195,000 to $335,000. Plus a required $49,000 franchise fee and six-figure liquid capital just to qualify. Prue sits at $430,000 to $680,000. And MiniLuxe, a brand explicitly trying to become the Starbucks of nail salons, asks for $547,000 to $925,000 in total investment, on top of a $1 million net worth requirement before they'll even talk to you. Same industry. A $5,000 booth rental and a $900,000 franchise buy-in selling roughly the same manicure. Before any of that money moves, though, there's a regulatory gate everyone clears regardless of budget. Every state requires a salon establishment license, a health and safety inspection of the physical space before you're legally allowed to open. Every technician needs an individual cosmetology or nail tech license. None of it is optional, and honestly, none of it is expensive relative to the build-out costs. But it does mean the real barrier here isn't money. It's paperwork density, stacked on top of a business that once you clear it, costs almost nothing for someone else to compete against you with. Which is where things get interesting. Walk into any nail salon, and the menu on the wall looks simple enough. Manicure, pedicure, a few upgrades. But that menu is doing more financial work than it looks like, and most of the real money isn't in the base service at all. It's everything stacked on top. Start with the foundation. A standard manicure runs $15 to $50. A pedicure $15 to $75. That's a wide spread for what's ostensibly the same 20-minute service, and the spread tells you something. The base price barely matters on its own. What matters is everything layered on top of it, because the base service alone barely covers the technician's time and the cost of the polish. The first real layer is the upgrade, gel and dip powder, which lasts 2 to 3 weeks instead of a few days. Clients pay a premium for that durability, and it costs the salon almost nothing extra in materials relative to what it adds to the ticket. This is where a sharp operator starts actually making money, because the marginal cost of switching someone to gel is small. The price jump isn't. Nail art is where a lot of salons quietly lose money without ever noticing. The instinct is to price per nail, $2 for a simple accent, $5 for something detailed. But that ignores the one resource that actually matters here: time. A technician spending an extra 10 minutes on just a little chrome on every single client, multiplied across a full day, can bleed a salon thousands of dollars a year in labor nobody billed for. Read that again. The operators actually protecting their margins have moved to time-based tiers instead. A simple accent that adds 10 minutes, detailed hand painting that adds 20 to 30, full 3D work that adds 45 minutes or more, each price to match. Anyone still pricing art per nail is functionally donating labor to their most demanding clients. Retail is the layer almost nobody uses properly. Polish, cuticle oil, hand cream, strengthener. Industry analysis keeps flagging retail as one of the most underused revenue streams in the business, and the reason is simple. It needs zero extra appointment time. A client already sitting in the chair for 20 minutes is a captive audience, and a $5 bottle of cuticle oil recommended at the right moment is pure margin, no additional labor attached. Most independent salons leave it entirely on the table. Membership and subscription models are newer, but they solve a real problem: the razor-thin margin on any single visit. $50 a month for 2 guaranteed manicures beats charging per visit, because now the salon has predictable, recurring revenue and a client who's already paid and is therefore less sensitive to price on any given day. Gyms figured this out decades ago. The beauty industry is only just catching up. Franchising itself is a revenue layer, but only for the company at the top. Isn't just making money on manicures happening inside its studios. It collects franchise fees, ongoing royalties, and revenue from a proprietary product line franchisees are required to stock. That's a fundamentally different business from the one the franchisee is actually running. The franchisor is selling a system. The franchisee is selling a manicure. Those are not the same economics, and it's worth sitting with that for a second. And then there's the layer that shows up on no financial statement anywhere: cash tips. In a personal service industry like this one, tipping isn't incidental. It's often a meaningful share of what a technician actually takes home. And because much of it moves in cash, it lives almost entirely outside the salon's official books. The price on the wall was never the full transaction. A chunk of what keeps technicians working for the wages they're paid is happening off the books, appointment by appointment. Here's where the numbers start telling a story about two very different versions of this business. Take the industry average manicure, $22.75, roughly. Now put MiniLuxe's signature manicure next to it, $30. Same basic service, same 20 minutes, same core steps. An $8 gap on a $20 transaction is enormous in percentage terms, over 30% for what looks to an outside observer like an identical product. That gap isn't better polish. It's the price difference between a business modeled on suppressed costs and one explicitly trying not to be. Which raises the real question sitting underneath every layer we just walked through. If the base service barely covers labor and the actual margin lives in art tiers, retail, and memberships that most independent operators aren't even using properly, how does the average corner salon stay open at all, let alone profitable, at $22 a manicure? The honest answer is that a lot of them aren't, not in any conventional accounting sense. They're surviving on volume, on cash tips that never touch a P/L, and on a labor cost structure that, in a meaningful number of cases, doesn't reflect what workers are legally owed. Every layer above represents the ways a salon could build a healthy, fully compliant margin. Most of the industry doesn't build it that way. Most of it builds the margin somewhere else entirely. That's not a side note. That's the mechanism the whole business rests on, and it's worth being precise about why. A nail salon sells an almost perfectly undifferentiated product. A manicure at one shop is, to most customers, indistinguishable from a manicure 2 doors down. There's no patent on a French tip, no brand loyalty strong enough to survive a $5 gap when the shop next door does the same thing for less. And because the barrier to entry is so low, a few $1,000s, a folding table, a handful of licenses, nothing stops a new competitor from opening across the street next month. Put those two facts together, and you get a business with no pricing power at all. The only lever an owner controls is price, and everyone else is pulling that same lever at the same time. Now look at the cost side. Rent is fixed. Equipment is fixed. Utilities are fixed. None of it moves much whether the shop is busy or dead. So when an owner needs to cut costs to survive a price war, there's really only one line item flexible enough to absorb the pressure: labor. And that's exactly where it goes. Commission-only pay running as high as 40 to 60% of a ticket. Tip dependency treated as assumed income rather than a bonus on top of it. Workers who are frequently immigrants, sometimes undocumented, often facing a language barrier, all of which makes them far less likely to report being shorted, denied a break, or paid under the table. One national study found the average nail salon worker losing over $9,000 a year to wage theft. That's not an anomaly. That's the load-bearing wall. Here's why that makes this a trap and not just a bad situation. The entire price structure of the industry, that $22.75 average manicure, was never actually covering the full legal cost of delivering the service. It was covering a version of that cost where a meaningful share of the labor bill simply wasn't being paid. Which means the market price you see on the wall every day is, in a real sense, a mirage. Not what a manicure costs. What a manicure costs once you subtract the part nobody's supposed to subtract. And a mirage holds up fine, right up until something forces the real number to the surface. That's the domino. It doesn't take much. A state labor department starts actually enforcing minimum wage law. An investigation puts a spotlight on the industry, and a governor orders emergency inspections. A wave of licensing audits sweeps through a metro area. Any one of those does the same thing. It forces salons to suddenly start paying what they were always supposed to be paying. And here's the part that turns it into a collapse instead of a correction. Because every salon in a given market was pricing off the same suppressed wage floor, the shock doesn't land on one shop. It lands on all of them at once. The corner salon surviving on $22 manicures built on unpaid overtime wasn't secretly more efficient than its neighbor. It was just as exposed. When enforcement finally shows up, there's no version of events where only the bad operators get caught and the good ones sail through, because nearly the entire market quietly built its numbers on the same foundation. Some shops close outright. Others go further underground to survive. A very small few try to rebuild on a different foundation entirely, one where the price actually reflects the labor. That already happened once, in one of the biggest nail salon markets on Earth. In May of 2015, the New York Times published an investigation by journalist Sarah Maslin-Neer called "The Price of Nice Nails." It documented exactly the mechanism we just walked through. Manicurists across New York City routinely paid far below minimum wage, some effectively working for tips alone, in a market where roughly 2,000 salons were competing for the same customers across 5 boroughs. A companion piece, "Perfect Nails, Poisoned Workers," documented the health toll of the chemical exposure that came with the job. The response was immediate, and it was structural. Governor Andrew Cuomo ordered emergency worker protections within days. Task forces, unannounced inspections, new licensing requirements, mandatory protective equipment. This wasn't a fine-handed to one bad operator. It was pressure applied across the entire market at once, which is exactly what you'd expect once you understand the trap. You can't selectively enforce a wage floor against a handful of shops when nearly the whole industry was built on the same suppressed cost foundation. Eventually, 652 workers won roughly $2 million combined in back pay and damages. Some salons closed outright. Others, unable to survive on a suddenly enforced legal wage floor, never reopened. That's the collapse side of the story. The other side is the attempt to build something that doesn't depend on the trap in the first place. And for that, look at MiniLuxe. MiniLuxe was founded on a simple, almost audacious premise. Take the most fragmented, least regulated corner of the beauty industry and Starbucks it. Standardize the training. Professionalize the pay. Sterilize everything obsessively. Charge a real price for it. That $30 signature manicure, sitting well above the industry average. The founders weren't naive about the difficulty either. One of the company's own executives put it plainly at the time. This is a hard business to scale, capital-intensive, slow to turn a profit, the exact opposite of a quick money play. They raised real money behind that bet anyway. $57 million total from private investors across several rounds. In December of 2021, the company went public on the Toronto Stock Exchange's Venture Board, completing what was at the time the largest capital pool company reverse takeover in that exchange's history. The stock had traded as high as $1.80 per share earlier that year. Then the pandemic hit, and it hit this particular business model harder than almost any other kind of retail, because a manicure is about as close contact as a service gets. MiniLuxe went from roughly 500 employees to under 20 within 3 weeks. Every studio closed. The company that had built its entire brand promise around being the safest, most sterile place to get your nails done was, for a moment, unable to operate at all, because no amount of sterilization solves for a virus that spreads through proximity itself. MiniLuxe survived. It restructured, leaned into franchising instead of owning every location outright, brought in smaller capital rounds through 2025 and 2026. A few million here, a few million there, described in its own press releases as capital-enhancing transactions. By 2025, it was reporting record annual revenue of nearly $28 million. And yet, as of mid-2026, the stock trades around 35 cents a share, roughly a fifth of where it once traded. 15 years in, after $57 million of investment, and a genuine attempt to rebuild the entire cost structure of a manicure from the ground up, the company is still posting losses, a profit margin sitting around negative 27%. Put those two stories side by side and you get the whole shape of the trap. Ignore it, and enforcement eventually forces the real cost to the surface all at once, the way it did across New York in 2015. Try to escape it honestly, paying real wages, charging a real price for real quality, and you're signing up for over a decade of capital-intensive, marginal-at-best economics. MiniLuxe's own words, more or less, before they'd even started. So which version of this business do you actually want to own? The worst case is the corner salon running on the industry's default settings. $22 a manicure, commission pay pushed as high as it'll go, margins so thin the owner may not fully realize how much of the cost structure depends on wages that wouldn't survive a labor audit. It works, sometimes for years, sometimes for a decade, right up until an inspector walks in, or a journalist starts asking questions, or a state government finally enforces a law that was always on the books. Then it doesn't just get harder. It can stop working overnight, along with every other salon on the block quietly running the same numbers. The best case looks something like MiniLuxe. Real wages, real training, a price that actually reflects what the service costs to deliver honestly. But best case here doesn't mean easy or even particularly profitable. It means 15 years, $57 million, a pandemic that nearly ended the company outright, and a stock still trading at a fraction of its high, still posting losses, still trying to prove the model can work at all. Best case in this business mostly means surviving long enough to keep testing the theory. That's the part nobody selling the franchise dream tends to mention. There isn't a clean third option where you pay fair wages, charge a fair price, and get rich quickly, because customers spent decades getting trained to expect a $22 manicure. Ask them to pay what it actually costs, and plenty of them just walk down the street to the shop that hasn't caught up to that math yet. So the next time you sit down in that chair and hand over $25, it's worth remembering what that price actually is. It was never really a bargain. It was a debt, quietly transferred from the price tag to the person holding your hand, one manicure at a time. And debts like that don't disappear just because nobody's collecting yet. They just wait for someone to finally ask who's supposed to pay.